Right then, what am I going to talk about today? Are we okay with sound? He's working on it. He's thinking about it. We are. Good. Consumer duty and green. You can't believe that two things that should be so straightforward appear to be causing so much difficulty in the world. Consumer duty, when you think about it, should be really easy because you're just doing the right thing by the customer. We have a regulator who's made it really, really quite complicated. And green and net zero should be really simple, but actually nobody can agree on a route map that works. But we'll get into a bit more about that later. Amy is here and has been for some time, since 2004, to represent brokers, to regulators and government so that they know the great work that is done by people who advise on mortgages and protection and make sure that they don't do something to kill the industry. That's my job. And I do that by working with a load of other trade bodies, whether it's UK Finance, Building Society Association, Intermediaries Mortgage Association, and it's really quite interesting. There are 3 lender trade bodies to deal with the different types of lenders out there, the 120 that are out there, and there's 1 broker trade body. And that gives us the ability to really focus on your voice and talking with one voice to everybody about what it is you do. We have other relationships with the Release Council, the Finance and Leasing Association, which look after the second charge market, the ABI that effectively are the protection providers trade body, and there's a protection development group who really are trying to bridge the gap to work out how we get insurers to behave better, which is quite an interesting challenge. I spent a lot of time talking to the FCA, which probably means I should have retired years ago because I'm really, really struggling with life having done that for so long. I also get to deal with the Ombudsman, and the Ombudsman's interesting, actually. I mean, the Ombudsman is interesting at the moment because they are using AI in a way that's really sensible. So if you have a complaint now, if you issue a complaint as a consumer or it comes back at you as a firm, that complaint that comes from consumer now is read by AI at the Ombudsman. And the AI looks at that and decides what the complaint is about and who would be the best person in their organisation who's got space in their work queue to take that next. So they're using machine learning AI technology now to make those decisions. At the same time, it looks at that complaint and finds the 5 complaints they've already reviewed that are closest to it and sends that to the person making the initial judgment as well. And I think that's a really clever use of AI that keeps people at the heart of what's going on, but facilitates the way that they do their job. And that's something that I think we'll have to think about more as we go through the next generation of Amy Chief Exec. And one of the reasons I'm probably stepping back is that I think that the next person who takes a job on is going to have to 5 to 10 year program looking at how technology works in this industry. And I'm a bit past my sell-by date on that. Because today is the 46th anniversary of when I started in full-time employment in Midland Bank in Hartlepool. So it's a time for me to go and do something else with my time. But our role is to talk about what you do to government and to regulators to make sure they understand and don't do stupid things that make it harder. And the more people that join, the more people that pay, the better the results will be for everybody. I'm going to talk today about really 3 things. How consumer duty has landed so far, the expectations that I think that the FCA want from you going forwards, given that this is never meant to be a static exercise, and talk a little bit about the green agenda in terms of what's going on. You should, if you're in charge of a firm or been involved in the management of a firm at all, done your annual review at the end of July. And there should be this wonderful little document sitting somewhere, filed either in paper or in an electronic form, that sets out what you did under consumer duty from the point at which it was implemented in 2023 to the end of July in 2024. And that document is meant to think about what it is you've delivered by way of improving and enhancing the customer experience and good consumer outcomes. And that's a document which if you haven't got, and the regulator rings you up and asks you to share it with them, you might find you're in a little bit of difficulty because they might ask you to stop trading until you can deliver it. Because that has happened in a couple of protection firms, insurance broking firms that I know of. The FCA has delivered lots of things for this that are quite complex because rather than just being in a rule book that says this is what we expect and there being guidance, they've been issuing things over a long period of time. There's been speeches, there's been podcasts, and they've mentioned it in their annual review and report. And what is even more interesting, they did a session recently where the session that they did was an hour long. The broadcast bit is 50 minutes long, so they cut 10 minutes out of it somewhere. And we've been trying to work out what the 10 minutes were. And it's actually when they said the most interesting stuff. But clearly the people who were speaking were not meant to say what they said, and therefore they're not repeating it, so it's out there. So only if you watched it live would you know what they said. And that's really I'm quite angry about that. Because a regulator should be so clear about what their messages are that they don't do things like that. But we'll have that debate with them next week. In all of this, what they're really worried about is the monitoring data you use for your business. How are you measuring what happens in the business? And those who've heard me speak before will know I talk about the sales funnel quite a lot in this area. I.e., if you think about where your customer starts on the journey, arrives as a referral from somewhere or just an inquiry that comes in through the door, how many of those people get to a fact find? Why do the ones who don't get to that fact find drop out? If you've done a fact find, but they drop out before you get to making a recommendation report, why have they disappeared? Once you've made that recommendation, you've got through that decision principle piece, what stops it going to an application? And for the stuff that goes to application doesn't go to offer. Why? They're interested in the gaps. And what is that total gap between the number of inquiries, the number of applications, and then the number of completions? And they're interested in those consumer gaps about why did it not go all the way through with you or with the industry? And that's the kind of stuff you need to be thinking about, not just complaints. It's about the outcome the customer gets. Now, there's a little work that some people have been knowing about for some time where they've been talking about the market in terms of equity release in particular and second charge. Second charge is still an area of extreme concern for them. Let me explain why. They're concerned about it because they've done some preliminary research looking at a very small number of cases in a range of lenders and brokers. They've done what they call end-to-end analysis. So they look at a case that has been submitted and completed in a broker, pull the file, and any call recording there might be. They then go into the lender and look at the file that the lender has and why they sanctioned it and what the application looks like and any recordings they may have. And they have found there's a significant mismatch between what might be on the file at the broker and what might be on the file at the lender in too many cases. So they're coming back to do a significant piece of work in Q4. They've now identified what they want to do with which firms, and they've allocated the resource now, so I expect that to happen in October onwards, and we will see the results of that probably not until the end of the first half of next year. I thought they were going to do an awful lot more work in the world of equity release because they have concerns about that as well. And what's happened there, though, is that if you're ever been involved in a big organization who does risk monitoring or risk management or creates risk maps, there's three measures that come into creating that. One is, what could the loss be? How much could it be? How often might it happen? And what is the scale of the industry or sector that's happening in? So there's three multipliers there that get you to that number of risk. When equity release was running at £6 billion, moving to £10 billion, that number was looking quite toppy and therefore higher on their risk register. As a market that's now less than £2 billion, it's dropped way back under a whole lot of other stuff that they're more worried about. And therefore it's been deprioritized because they look at this very analytically and through data, not just through the simple lens of, might there be some customers who are not getting the best outcome? Because it's not on a scale enough for them to intervene because they think the industry would be able to sort it out through whatever compensation scheme that we might have to run later on to deal with it. And therefore they're a very judgmental regulator in terms of where they will go and what they will do. But this all links into consumer duty because their argument now is, we will just assess against the outcome later, not about whether you followed the process. They've also asked us for input on, because we now have this output-based regulation that says consumer duty is all about outcomes through 4 particular scales, are there certain rules we could get rid of? Are there parts of the rule book that shouldn't exist? So it might be, we think about saying that, well, the way you have to express interest rates and explain to customers sometimes that the interest rate that's by the rule book, the cheapest or the lowest, isn't actually the best for them because it doesn't take into account certain of the things that are of a benefit to the customer, i.e. cashback or free legal, because that doesn't get taken into account in those interest rates. And therefore, you're often having to go through that explanation and also explain to your compliance department. The cheapest rule means that sometimes there might be other parts of the suitability process that run counter to the cheapest. And going through that explanation makes that rule almost redundant. But it sits there and is in the way. It might be there are other parts of the rule book, particularly in my view, around why do you have to hold a consumer credit permission to merely talk to somebody about repaying some of their debt or not repaying their debt when you've got a fully authorised mortgage permission that should allow you to do it anyway. So can we get rid of that stupid rule that says you've got to hold a consumer credit licence and hold all that stupid stuff that gets in the way of just getting on with the job? Because at the end of the day, the outcome is, have you given the right advice to the customer? And these are the kind of challenges we're going to put back into the regulator to say change the rule book. Simplify it. Get rid of the complex stuff that gets in the way of doing the job that's easier for us to deliver. They're still concerned about vulnerability, which is interesting. They're pushing quite hard back in to say, why is it that lenders have lots of customers that they're identifying as vulnerable, but brokers are not telling lenders that they've got anybody who's vulnerable, or very few people? And I say to them, that's really interesting. Because if somebody's applying for a credit card or a savings account or current account, or protection even, it might be that that person has got significant vulnerabilities. However, if they're applying for a mortgage, they're probably in employment, turning up for work every day, and actually relatively healthy. No shit, Sherlock. Less vulnerable. They might have issues with reading, writing, maybe probably not if they're in employment. They might have other fragilities around physical health or mental health. But would you want to share those with a lender before they've completed the application? The customer certainly might not want you to share that with a lender before the application's been approved. We've got this push-pull at the moment about how this works that's quite fascinating. And then there's the stuff that really scares the crap out of me. There's the stuff that's come over the line on general insurance, where basically they've said to the industry, on general insurance, you are crap. The worst example being gap insurance on motor vehicles, where in the worst firm they could find, for every £1,000 of premium that the firm was taking in, they were paying £40 out in claims. That makes PPI look really, really clean and simple. £40 out of 1,000 paid back out in claims. Other £960 being trousered by the insurer and the person selling it. So that's the most egregious example of all of that. Where we are, though, however, is in other parts of that landscape, there is not deemed to be sufficient challenge between the broker and the insurer about the fair value of that product, the quality of that product, and the servicing of that product. And it's for servicing that's beginning to become a bigger and bigger issue, where I know some of you in this room will probably have had issues with underwriting that's taking longer and longer and longer, and claims, even for life claims, have been taking longer than they used to with certain providers. And the regulator is unhappy with this. And that's the kind of push-pull we're beginning to see coming out of duty that would not have been picked up in the same way under the old rule book. And we have to think about things in a different way. And so we've now got more and more work coming. And now there's also a pure protection market study coming. And what they're asking here is the customer getting the best deal? Is going to challenge, you see it on television, all these adverts for over 50 life insurance. That has got one of the lowest payout rates of claims to premiums of any product in the sectors that you sell. They're concerned about churn, i.e. how many times we actually move a product on. And actually, that is actually probably more a problem of some of the non-advised firms unpicking the good advice work you've done by telling somebody to get a cheaper premium, but for shit cover. So they're going to look at that. And they're also going to look at where there is loaded premiums and how much money goes where in the distribution chain. This will be a long-term piece of work. So they'll call for what evidence they think is required, which runs out at the end of October. We will then get full terms of reference in Q1 next year. All the data will then be pulled in. I would imagine their first draft report will come in Q4 next year, when we'll then get finalised report early in 26, and rule changes recommended as we get into 27. That's how long these things take. Long-term programme for change. But it risks being quite difficult. So, your plan looking forward should be, having done our annual review in July, what are we going to continue working on this year to get better at? And every firm should have that out of their review. Because remember, in July 25, you've got to do the same exercise you've just done in July 24 all over again, to look at what you've made better or different or improved on, or what's got worse and therefore what you need to change. And I'm going to ask a question that the regulators are beginning to ask more and more of firms as we're getting deeper into duty. What is a good outcome for the customer? What's a good outcome? Is it they get the house that they wanted, or they can stay in the house that they're already in? Is that the good outcome? Is it that they got the best mortgage for the house they were looking to buy? Or is it they got the best house, the best mortgage, and got a decent GI package so that actually if something goes wrong, as Neil will tell you, if it goes wrong, you can still claim? Or is it a fully protected mortgage with life, kick, IP, with a great mortgage to keep them in the house forever if something goes wrong? Is that the good customer outcome? Because you have to define that as your service proposition and be clear about what it is you're trying to deliver and measure yourself against how often you deliver that. And when you don't deliver that, why? Why do so many customers say, I don't want that element of your service proposition? That's the clarity that the regulator thinks we need to get to. I'm not saying it's right or wrong. I think that's just where they are now in their thinking. It changes the shape of what it is we do. It's not about outcomes that might be bad for us. It's outcomes that really work for the customer. And it's about how you measure that and work with it. Some of you might have seen a bit of noise in the press when Lloyds recently introduced a policy on broker fees. I got vexed, as I often do, being an angry Scotsman most of the time, and told them they were stupid and to withdraw it. And what was happening here was that, and they have been doing it for a long time, lenders have been looking at the level of fees that broker charge for various types of lending. And I was cited one example where a broker put a £2,500 fee on a £70,000 further advance. That sounds pretty shocking. Until you dig under the bonnet and actually look at what was happening alongside it. Because there was a further advance on that property. There was a let to buy happening on another property and a refinance of another property. And what they did was they dropped the fee for effectively 4 transactions onto the cheapest bit of borrowing. But didn't tell the lender they were doing that in any way. So when the lender saw that fee, they panicked and were really quite scathing, until we got to the end of the process and understood all the things that sat behind it that justified it, but the customer was really happy about that fee for the amount of work the broker had done, because it had taken the broker a year to get all these transactions lined up and into place so it could be done. Sometimes what looks unreasonable is not unreasonable. The moral of the story is, be clear about why you're doing what you're doing, explain it and put it out there clearly. There are approximately, and I say approximately because nobody really knows the numbers, about 10,000 firms out there, all with slightly different charging structures. They shouldn't be all different, but they are. The average broker fee, half of mortgages still written don't have a fee attached to them, broker fee attached to them. That's not all London country. There's little brokers out there who do not charge a fee. Half of them do not charge a fee. Of those that do charge a fee is £424 broadly. That's just an average. That could be 199, it could be 999, depends on the case. What I can say to you is that of that roughly 10,000 firms that are out there, if I go and talk to a lot of lenders who are really monitoring this, there are about 50 firms that cause them concern about the level of their fees. 50. And they're now working with them, talking to them, trying to work out why they are where they are and doing what they're doing. And when I talk to different lenders and some of them share information with me confidentially, I see the same names across all the lenders. So it's not 50 firms times 10 lenders, i.e. 500. It's broadly the same 50 firms no matter where I go. And therefore, we're going to see a bit of alignment, but what I didn't want was 120 lenders publishing a fees policy that would drown you in bureaucratic shit. Because we don't need that. We need proper dialogue, proper policing, and proper discussion between people about the why, not the what. And that's really, really important. My favourite subject. I like warm weather, but it's beginning to get a bit too warm, possibly, for certain places I'd like to go on holiday. We got it a bit wrong, I think, by taking the pressure off the private rented sector, the 25 number, because, well, you could argue there are too many Tory MP landlords. You could argue that perhaps we couldn't do a 25, therefore take the pressure away. What is clear, though, is that in answer to a question in the House of Commons recently, it was said that all private rented sector properties must be C or better by 2030. That has been repeated under this new government. However, there is no roadmap in any way, shape or form coming on this at the moment. It always worries me when a failed Labour Party leader is the person responsible for delivering this. Ed Bacon Sandwich Miliband, who is the person who's got to deliver this. Now, we will get to a point somewhere in the next few months where I think they will come to us with a roadmap or a macro level of what the government expects from the industries. And when I say industry, I mean the retrofit industry, the new build industry, and the funding industries in order to get to net zero by 2050. It's too expensive, however. If I look at this through another lens, we have a target of building 1.5 million new homes by the end of this current Parliament. With a fair following wind, in the first year, Angela Rayner and Keir Starmer might get 200,000 houses this year. That means in 28 and 29, they've got to build 400,000 houses to meet that target. A supply chain that's going to be twice the size that it is now. So that's twice as much supplies, bricks, timber, materials, twice as many bricklayers, twice as many electricians, twice as many plumbers. Likely to happen? Possibly. But at the same time, can you retrofit roughly 3 million properties to get them to EPC C or better? Not going to sodding happen. Something will have to give because it doesn't work. So unless we actually take all the people that we're currently running through university, put them into vocational colleges and train them to do something different, and actually that might be a good idea for a lot of people not to walk out with £70,000 worth of increasing debt round their neck and actually get a job which will pay them probably more than they would ever earn as graduates in jobs. Because you are beginning to see the benefit, the real benefit of people walking out of university with 60 to 65 to £70,000 worth of debt, and with interest rates where they are, people now on salaries of £50,000 a year seeing that debt continue to increase, and how that works on affordability as that begins to impinge on their ability to show income to get affordability. A shocking piece of backsliding by a government who outsourced that debt from their books because it was getting so big it would damage their fiscal rules. The stuff that happens that are just done by sleight of hand that now impacts people in a very different way and is now sitting on the public balance sheet as opposed to the government one. And we will see that happen here because they will have to move all of this onto the public balance sheet and not the government's balance sheet because the bill is too big. What I would say to you now is retrofit, whether it's solar or heat pumps or insulation or changing your light bulbs, advice will have to be given very carefully. All the lenders I know and talk to are trying to work out processes where they can take people through tested and safe advisors and tested and safe suppliers. None of them is really in a position yet where they think they can build this. And it's going to take them probably another 6 to 9 months before they begin to feel comfortable. So we're a long way out yet. But the clock is ticking. The end point is not going to change. Because the end point is not 2050 as a token date. The end point is we're over a hill and actually the temperature change becomes irreversible. With us as humans on the planet, it will reverse if we're off the planet, but not while we're on it, which is quite an interesting problem. So we continue to work. We have a group called the Green Mortgage Advice Initiative, which is a mixture of broker firms, lender firms, surveyors, and Trustmark, trying to work our way through how we do this for people, but not in a way where we're prescriptive about solutions. We want to leave the market open to see things work in a way which allows test and learn. And we are seeing some lenders test product, take them away, try things out, take them away, work out what's got traction. But the key message still is that on Rightmove, people looking for green solutions is still a very, very small number. And builders do not have people walking in saying, I want the greenest house possible. Strangely. So the challenge will be, how do we educate? And I'm afraid you might well get caught in the fulcrum of that, because you are the people who actually end up sitting down talking to customers most about the stuff that matters to them most. So, out of all of that, the world is getting more complicated. Really complicated. Getting more complex for consumers, getting more complex for you, getting more complex for lenders. That means that advice is still a fundamental part of this. Technology, AI, all that stuff, it might do some of the heavy lifting. But ultimately, whites of eyes, talking to people, understanding their demands, what their needs are, what they want, converting that into solutions, that's going to be human for as long as I can think of. Therefore, you are valuable. What you do is valuable, and do not forget that. You deliver value to people. I think 2024 will end well because interest rates have got a lot better. The market is intensely competitive. Lenders are looking for volume now because they know stuff that comes on the books now completes next year. They know what they're going to finish with their numbers are at the end of this year. They're trying to work out what their bonuses are in 2026 out of 2025's business. Because that's what bankers do. But how there are immense pressure on margins. You have to see some numbers of figures quoted in the press yesterday about the number of brokers that have left the industry, i.e. people who came in and found it too tough. If you're sitting here, you are resilient. You are good at what you do. But pressure on margins in lenders and in broker firms is tough because your income is dropped because of the amount of PT work. Your costs are not going down, which means you've got to get smarter or sell more protection. It's the only two options you have. And the last thing I would say to you is, one cost I would not run away from is compliance support. I think in this world, in order to stay safe on the pitch and trading, good compliance support companies, whether it be Simply Biz or Paradigm, Bankall 360, they're out there to help you stay safe. And in the world I see going forwards, having a hand to hold or somebody to ask questions of is probably a safer place to be than trusting your own judgment around all of this. With that, I'll remind you of what I was going to talk about. Say to you, thank you for listening. Enjoy the rest of your day. I'll be around for a while if you want to talk to me. But keep doing great work and enjoying what you do, because I think you work in one of the best professions in the world. So please enjoy. Thank you very much.